good morning, everybody. Welcome into this week's long form episode here on Mining Stock Daily. I'm Trevor Hall, your host. Once again, with a long form discussion with our friend Barry Knapp. He returns to MSD for a timely discussion on the macro forces driving markets and what investors are grappling with what Barry calls a potential inflection point in the AI trade. We shift through federal policy as that meeting's coming up next week. Signs of volatility beneath the surface as well. And we dive a little bit into the KOSPI. Is it sending an early warning? Is it a canary in a coal mine on the AI trade and a signal for the U.S. stock market? Barry believes the rate of change in AI investment matters more than the absolute level of spending. We dive into this discussion with Barry. Obviously, a little bit of a discussion on the move this week in precious metals and what that represents with correlation in the same move higher in bonds and in the dollar. So thorough conversation, 1 hour in its entirety. Hope you enjoy it. Special thank you to Vizsla Silver, Revival Gold, Integra Resources, and Equinox Gold for their continued support of this podcast. Another great listen to get you through your summer here as we are in the height of the summer. People seem to be at the beach. So, all right, everybody, enjoy my conversation with Barry Knapp. Well, Barry, it's always a pleasure to have you on to the podcast. You and I haven't really chatted since before World Cup, but that's all wrapped up. And I guess, nothing to keep us completely distracted from markets anymore now that the World Cup is finalized. But yeah, that was quite the event. I mean, there was no dull moment for a month and a half, were there?
Yeah, it was a major distraction for me, to be sure. Everything from people who don't know the sport and were, betting on online websites and asking me for my opinions on various matches to, obsessing about the weaknesses of the U.S. team, which I think you and I discussed, that came out in spades in the final match.
Yep.
The manager, who I questioned all along, the heart of the team, the defense, and in particular Tim Ream, and then the most glaring flaw of the team of all, which was in the goal. It's kind of shocking considering the run of great keepers we had: Tony Meola, Brad Friedel, Casey Keller, and of course Tim Howard, and then to have Matt Freese, it's just such an incredible weakness there. Anyway.
Yeah. Well,
so we have a developmental problem in this country. At one time I was on the board of the foundation, actually made a connection right after the tournament ended between someone senior at the federation and the foundation. And hopefully there'll be a focus on the 7 to 13-year-old age category and more programs to find players in that age category that, may not be able to afford expensive club soccer. That's not, I know that's become fashionable to talk about pay for play. That's only part of the issue. The real issue is that we're just not capturing players at that age group. It's not about athleticism and our best athletes going to other sports. It's just not the issue. The issue is we're just missing a lot of talent in that younger age category. I spoke to a friend of mine's son who's an assistant GM at one of the MLS clubs about it. And, we've all done our soul searching about the sport in this country. And that to me is the biggest glaring hole. The only other two other comments I'd make. One is, my long-held theory is all things equal, the team with the best midfield wins. Having played center midfield for 52 years, sort of biased in that, but that generally is true. And Spain's midfield was just light years ahead of pretty much everyone they played, including Portugal, which was surprising. Portugal's just never got the mix right. Their players,
No.
player for player, they were just as good as Spain, but they didn't get the mix right. That's why Spain won. And then for people that were surprised about Argentina's behavior in the finals, they haven't been paying attention because this has been going on for 60 plus years. I actually went and played golf and watched the final on tape because I was just so disgusted that Argentina was in the final. But nothing against the Argentinian people or the president of Argentina, but their sport around the culture around the sport was just despicable, including Messi. His behavior was reprehensible. So anyway, enough on that. So rant over.
Well, I was a little torn. I was very much torn with Enzo Fernandez myself. I was happy for him to have success, but I was
I hope
also
Chelsea
a little
sells
bit.
him.
I don't know where he goes. If it's not, doesn't sound like Real wants him. Maybe Atletico. I don't know. We will see. Okay, but we could do a whole hour just talking World Cup, post World Cup conversation. But now that it's over, let's do kind of focus on what people came
to hear. Not my
Mostly,
opinions on the sport. Yeah.
Yeah. So let's focus on markets and the economy here, Barry. You really captured my attention last week when you published a new note called Second Order Derivative. That's actually behind, or it's in front of the paywall now, so anybody can go onto your Ironsides macroeconomics Substack and read it. And read it and kind of gain information from there. I will try to put in a link to the show notes to get that in there in front of everybody. But you are starting to kind of gauge the focus on investors right now on whether AI CapEx is still growing or maybe the rate of growth is more important here. And really what this means with the AI boom. And I've never actually asked you if you've considered the AI sector a bubble. So maybe let's talk about that now and kind of how you're watching this whole thing play out. And if you were back at your desk as managing director at Lehman Brothers, how you would be watching this at the time?
Yeah. Let's get back to monetary policy later as well. But because I do think that there's pretty good risks of a risk-off shock. The yen is sort of at the center of that, but on the AI progression, I don't know. Bubble is, everyone's got their own sort of definition of bubble, but this is an investment boom, no question. There's differences between the broad boom in the 90s and this one, in part because we had strong CapEx across a broad range of sectors for an entire decade in the 90s. So by the time we got to the end of the cycle and we started to realize that we had excess capacity in fiber optics cables and PCs and, everyone's offices and the like, we also had a decade-long boom in CapEx. We have not had a decade-long boom in CapEx. In fact, we had the weakest CapEx cycle weakest since World War II in the 2010s, which is interesting. For anyone who's really wants to get in the weeds on monetary policy, you can go back and read Jeremy Stein's 2012 speech, where he talks about how reducing the term premium in long-term treasuries was unlikely to boost CapEx because there was a sort of we're going to lower that term premium now, but then we're going to unwind it later. And as a consequence of that, anyone doing a long-term capital plan would be disinclined to do so as a consequence of that. That turned out to be a really prescient speech because CapEx was weak the whole of last cycle. So what I think is going on right now is we're in a transition between I do think we'll have a stronger, broader CapEx cycle, a manufacturing renaissance, so to speak. We rebuild our manufacturing base in this country, and I do think that that will occur and will persist through the course of the cycle. But we've reached a real inflection point in the rate of change of spending on AI. And the big picture metrics, which I think you and I may have talked about. If not, I've certainly written and spoken about it a lot, including television appearances and in my work, weekly that I do was, there were two metrics I was sort of really focused on. One was CapEx as a percent of EBITDA or cash flow. When we got to 80% for the telecom sector in 2000, that was pretty much the peak. They were using up all their CapEx. Now, those were slow growing baby bells that were at the core of that, and then a bunch of leveraged other companies like, MCI, which became WorldCom and Global Crossing and the like. But they were essentially spending all their cash flow on CapEx, and that was a point that marked the end of the cycle. The same thing happened in the energy sector in 2014 and 2015, and then, of course, that was the peak as well. We're above that level for the big four spenders, meaning Google, Amazon, Microsoft, and Meta. So we're at that 80% level. We know that their stock prices have gone down since last quarter's earnings. Remember, last quarter, they all reported on the same day, which happened to be a Fed day as well, April 29th. And so the market is sort of pushing back on this incredible pace of increasing capital spending. So now the question, so that was sort of big picture metric number one, was how much of cash flow were they spending on CapEx? The second broad macro perspective I had on this, which is sort of my approach to it, is look at the broader macro picture, was credit. And while, I wrote in my outlook back in December that I thought that CapEx related financing would push real rates and nominal Treasury yields higher this year. My target was 4.5% on nominal Treasuries, nominal 10-year Treasuries, that is, and 2.25% on 10-year real rates. We got to those levels after the war broke out. We retraced part of the move, but we're above those levels now, solidly above those levels. And while I thought we'd get some credit spread widening to signal the market was starting to struggle with that, instead what we got was redemptions from private credit. And so investors were pulling money out of there, presumably because they didn't think it was marked properly or whatever, but it was illiquid to be able to get the capital to be able to invest in all these CapEx related deals. To be sure, if you're buying Microsoft 30-year paper, that's a pretty good credit. We're not really worried about Microsoft blowing through all their CapEx and having even if their stock price goes down, credit will still be good, right? So there has been clear signs that we've reached a bit of a saturation point in that capital spending. And for people to say, hey, the market's absorbing this, no problem. All we have to do is look at the stock prices of the big four spenders and see that they're going down to know that the market's not 100% comfortable with all this. So then if you do have a rate of change, a deceleration in the growth of capital spending, I'm not talking about CapEx cuts necessarily, I'm talking about just that starting to flatten out that growth rate. Well, that permeates out through the whole system because we know there's all these, cross deals going on. You're going to buy my chips, but I'm going to finance the purchase of my chips. Caterpillar Tractor has been famous for that over time, right? And Caterpillar Tractor is part of this whole story, and GE Vernova is part of the story. You're going to buy my turbines, but I'm actually going to finance the purchase of my turbines. And, the financing starts to get overly opaque. There was a deal this week. I didn't really have a chance to look into the details of it, but the financing of it looked really funky. A TeraWulf deal, partially backstopped by Google, kind of that kind of stuff would indicate we're reaching a bit of a saturation point. Now, the market bounced. I wrote in my note this week that with the semiconductor index down 20% from the peak, which came 2 days before Micron reported in mid-June, and having done a 38.2, Fibonacci retracement of the rally from the bottom in the war up to that peak, it looked like you'd get a little bit of a bounce here. But those questions are still pretty acute. And again, I'm not suggesting this is the end of the cycle. We haven't even had all those mega data centers come online, but it may be the peak of the speculation in the equity part of the capital structure in the cycle. And so, yeah, the earnings could keep going for some time, but even within the semiconductor sector itself, there's a real question about how you value companies where they're getting this surge as we build out this infrastructure, but it's unlikely to persist at the same level. Everyone's trying to pick the peak and then say, okay, well, how do you value that? Is it like a company that pays a special dividend type of valuation metric? And the way I learned investing in cyclicals was you bought them when the PE was a sideways 8, meaning infinity, they were losing money, and you sold them when the PE was 4. And the attractiveness of these big 4 spenders was always that they were capital light, very high cash flow businesses. Well, they're going to become far more cyclical. I mean, they already have Google and I'm getting a little bit into, fundamental individual stock picking analysis. It's not really my thing, but, Google and Meta are very heavily geared to advertising. Of course, we know there's cyclicality to that. And then if your fixed costs are much higher than they ever were because you have big stakes in all these data centers, that inherently makes you have significant operating leverage on the upside and downside. And so they're not going to be capital light businesses. And so you wouldn't expect them to trade at premium valuations any longer. So, to me, it looks like we're really at an inflection point with this whole story. Again, we could get a very good, and we've had something of a reset of expectations already, and it may be partially sufficient to discount these growing risks or a rate of change of slowing. But it seems likely to me, and from all my discussions with clients and investors, that we've reached a real inflection point, and that's that second order derivative rate of change slowing.
So an inflection point, let's talk about the dangers of this inflection point. Obviously, it feels like some sort of transition, but historically, we talked about the cyclicality of this. Historically, what are the dangers in front of us right now? Not only with kind of this maybe revelation that the speculation is starting to wear off in this sector, but also just the way the structure of the market is set up with the incredible amount of passive investment funds that are just clinging to this sector for continued inflows. How dangerous is this right now, Barry?
Well, we have my brand is it's never different this time, right? But there's something that's clearly very unique in the structure of the market, in as much as we've never had this big a spread between individual equity vol and index vol, right? So the VIX EQ relative to the VIX. And we are in a period where, with tech and tech related and the AI theme in particular, we're getting vol up or price up, vol up. That's what happened at the end of the tech boom in the late 90s into 2000. I can remember the divergence in that case was between NASDAQ and S&P. I was in equity derivatives at that time at Lehman Brothers. And that was just underscoring how the risk was growing in that tech sector. We had a similar move in the summer of 2021 when we had all that liquidity, and then upside, the skew flipped, right? And so upside calls were more expensive than downside puts. And of course, the crash of 87 is what started the smile, and it's been like that ever since. And it's still like that for the index, but in this one particular sector. So it just underscores that concentration risk that, Mike Green talks about a lot. And, my colleague Dean Kernett at Macro Risk Advisors talks about with respect to triple levered Korean single stock ETFs, which I don't know why you have ETFs on single stocks, quite frankly. I feel almost guilty about my role in the growth of indexation and exchange traded funds. We were doing transactions like that for macro hedge funds in the late 90s before there were such a thing. But we did them on sectors and the transport index. And anyway,
Yeah.
so there's this incredible amount of concentration and that divergence between individual equity vol, which underscores that risk, and the low level of the VIX is because correlation at, 13% implied correlation of the top 50 names was just levels we never thought possible. When implied correlation went to over 60% before the Iraq War in 2003, that was something we'd never seen before. We never thought it would be that high. And then, of course, it went to 80 after the global financial crisis. And, it was fantastically high. Now it's incredibly low. And so we've have this two-tiered situation where, the core economy looks robust. We are getting, retail sales has seemed to have overcome the 4 adverse aggregate demand shocks. That was lower group population growth, right? The immigration policies that slowed spending, overall aggregate spending or aggregate demand, the slowdown in government spending from 11% in Biden's final year to 3% through the first 21 months of the Trump administration. So those both lowered aggregate demand. But then you had tariffs, which lowered aggregate demand and put pressure on margins, and energy, which did the same. The economy seems to have overcome that. So you've got what looks like broadening financials, but you still have a fair bit of policy risk, and you have very low. I mean, the market's priced very low risk, right? With the VIX at 17 or so, you'd have to say that the market is not priced to absorb any kind of a macro shock. And that's where I would come to the Fed and Federal Reserve policy. And so that's, you've got this, I wrote in the final section of my note last week, I wrote diverging micro and macro story because I did expect that we would have disinflation, that energy would not create an inflation problem, and it is not. You have the inflation break-even curve below where it was when the Fed started cutting last September. So inflation's not the issue here. People misunderstand when they say, hey, energy's up, that's inflation. That's not inflation. That's a price hike that without accommodation from the fiscal or monetary authorities is more likely to lower aggregate demand than raise it, as I just stated. That said, you've got rising real rates, this push that AI infrastructure has created on longer term real rates. And you've got a Federal Reserve that has quite a number of committee members that for, I don't know, Dave Zervos would tell you political reasons, and I think there's an element of that for sure. But you've got a number of them that are not willing to look through the cost push price effect of building out this AI infrastructure towards some productivity dividend down the line and a new Fed chair that may want to do something of a CEO reset. Like, we get a new CEO and he wants to mark down expectations so he can start over and then build from there. You've got a potential hawkish crack up here. And you also have a very complex situation, which we've talked about before, about the Yellen Treasury and Powell Fed having left Treasury Secretary Bessent with 33% of financing in the front end of the curve in bills. even though the Treasury Borrowing Advisory Committee suggests it should be 15 to 20. So no easy way to unwind that. And the Powell Fed that left Warsh with a bloated balance sheet with very long duration, much longer than Treasury's outstanding, and no easy way to unwind it. And a Fed balance sheet that could be providing, I've been calling it 50 to 75 basis points of additional accommodation, but there's an argument it could be as much as 150. So that is really what's providing accommodation to the hyperscalers funding this AI build out that's creating cost pressures, in people's iPhones, which again, I don't think the right way to address this is with rate policy, but I'm not on the Fed, right? So
right.
They may decide to address it, in which case you're going to create some cracks in the system that could lead to a pretty good little risk-off shock here as soon as the next couple of weeks.
Hey, stay right there. We'll be right back after a very short break.
In mining, the difference between a good project and a great investment often comes down to one thing: visibility. Tara Hutton is a Sweden-based mining investor platform built to make the invisible investable. Even the strongest project can be overlooked. Geology is inherently complex and data-heavy, and when it's reduced to raw numbers like drill results and technical reports, investors can miss the story, and companies can miss out on investments. Tara Hutton brings mining projects into the digital spotlight, combining data, narrative, and context in one place, so investors can see not just what a project is, but why it matters. Whether you're evaluating early-stage exploration or more advanced development assets, Tara Hutton helps turn complexity into clarity and information into insight. The kind of transparency that builds loyalty over time. Visit tarahutton.io to learn more.
Hey everyone, Justin Hune of Uranium Insider here, inviting you to check out the Going Nuclear podcast, co-hosted by yours truly and Trevor Hall and produced by the Clear Commodity Network. Each episode, we dive deep into the uranium sector and the fast-evolving world of nuclear energy and uranium investment. From supply dynamics to policy developments and market trends, we bring you the insights that matter most to energy investors and industry watchers. You can find Going Nuclear on Apple Podcasts, Spotify, and at clearcommodity.net. Clear Commodity Network, digital news on the physical markets.
Barry, I think, I've spoken with enough people who have been in markets for decades, and one of the stories that always has stuck with me is people who were on the street, prior to everything hinging on a Federal Reserve policy statement every month. Back in the day, nobody paid attention. They'd go out for lunch when the chairman went to his presser, right? Or, didn't pay much attention because it was right.
There were no pressers. What happened in my early days at Lehman Brothers was you'd hear the government hoot say, hey, the Fed just did reverse repos, which meant they withdrew money from the system. So they had just bumped the policy rate up, right? And then we got to 1994, and there was a brief statement after they hiked the policy rate in February of 1994 that explained that, they'd actually done it. That was the first time they told us, right? So what they'd done. But
I make that statement just because so much more hinges on those statements and on those meetings now than they did. In fact, in my early novice career, obviously not as much of experience as you have, but I've never known a market not just cling on to a Federal Reserve statement during those meetings, right? And so people just hang their hat on what that direction is, what the dot plot says. Oh, we may be getting rid of the dot plot, it seems like. But where we sit now, we're still kind of torn of what that current policy, as we sit here in late July now, Barry, what that policy in front of us looks like. Now, you have been out front saying the need for rate cuts. You and I have talked about that for the last probably 2 years here on this channel. But the market's looking at a different direction. So maybe talk about that disconnect between market expectations and where you think the fundamental driver needs to be for a general CapEx boom that doesn't have to hang its hat on just, AI data center build out.
Yeah, let's do that. Well, first, it's important to understand that the Fed is staffed with new Keynesian economic thinkers who rarely spend time on the supply side of the economy. And the new Fed chair has made it clear he's far more interested in the supply side than the vast majority of the Fed staff or the FOMC committee, who is solely focused on demand. So for them, demand is fairly homogeneous. If it's consumer demand, it's effectively the same thing as CapEx related demand. Supply sider would say, no, those are not the same thing at all. Okay. Consumer demand can drive up price, all things equal. An increase in demand drives up price. A supply sider would say CapEx demand shifts the supply curve and the price theoretically remains the same or even goes down, right? Warsh has one view. He hasn't remade the Fed to have more supply side thought. So that's the core debate at the Fed right now is AI is driving up demand. Okay, but is it also shifting the supply curve, and is that happening fast enough to avoid an increase in expectations? Now, I think, again, these new Keynesians overweight expectations. It's really had little to do with inflation in the past, including in the 70s, but they're convinced that it is a big driver. So let's just start with that broad background about understanding the debate. We then have the issue. I think that the policy rate is at least a half a point too high, but I think the balance sheet has been providing at least a half to 3/4, maybe as much as 1.5% of accommodation, and there's ample evidence of this. All we have to do is look to what happened to the housing market during the Fed's pandemic policy panic when in 2021, even as the economy was reopening and was clear, the recession had lasted 2 months, they were still buying $40 billion of mortgages a month and reinvesting $55 to $60 billion a month. They drove the spread of treasuries to mortgages to all-time tights, which brought private equity money into the housing market. And they drove mortgage rates to all-time lows. The correlation of the 20 cities in the Case-Shiller Home Price Index was 0.98 for 11 months. That is a statistical almost implausibility, if you will. It could only happen because of this big macro force, and it drove house prices up 46% and created the affordability crisis. I yelled at my screen at every press conference when Powell got asked about the housing market and said the Fed has nothing to do with housing supply. They basically created the affordability crisis, and it's almost impossible to unwind it. So they eased through their balance sheet, and then when they tightened for reasons that are just ridiculous, this transparency and the public will understand it better, they tightened primarily using rate policy. That created the K-shaped economy. ROE of small regional banks is 3% lower than that of big banks. The typical spread would be more like 1.4%. So big banks benefited because they had all the cash and their bond portfolios looked like the Fed's, whereas small regional banks were dependent upon a steep yield curve to be able to lend money. It's called maturity transformation in Fed speak. Small business employment is negative. Large business employment is strong. Households that own assets versus those that don't, the whole K-shaped economy. So Warsh, if he had his druthers, would rebalance all this. And he is going to rebalance all this. That's what the 5 task forces are all about. And the people on the balance sheet task force, I know, are supportive of it. I've read their writings, right? I know where this is going, but it's going to take time to get there. So the first thing that they're likely to do is those reserve management purchases that Lori Logan and Beth Hammock talked Powell into because they were worried about repo rate volatility. This is, Lehman Brothers was run by former, commercial paper traders. Those are not the guys you want. Like, they don't see the big picture. They're just involved in the plumbing. And Moore said that last week. We can't let the plumbing dictate the architecture. The architecture needs to dictate the plumbing, right? So the first thing they do is they end those reserve management purchases. The next thing they do is they change their reinvestment strategy. So they start reducing the duration of their portfolio outstanding. They wait for the results of the task forces, which we know where it's going anyway, which is let's loosen bank regulatory requirements, reduce bank reserves from 3 trillion down to something more like 2, but it's a complicated process to get there. In the meantime, you have this argument that I started with about what is AI really doing for the rate of inflation and the cost of living for households? And, Warsh has said a number of times, rate hikes or rate policy gets in all the cracks. It affects everyone. I think it would be a massive mistake for them to begin this process to try and address the 150 basis points, or we'll call it 75 to 150 basis points of accommodation that balance sheet is providing by hiking rates. That to me would just make that K worse. And so were they to decide to do that, I think we'd have a big crack up, and that crack up would start with dollar yen, yen just cratering, forcing the Bank of Japan. Intervention we know doesn't work, and then they have to hike rates. And as they continue to do that, we know the Japanese are the biggest global holders of fixed income, so you put more pressure on the back end of the Treasury market, and you potentially have a whole risk-off scenario unfold. Now, the probability of them hiking next week has gone from single digits to 38% as of this morning. Yesterday, that was surging. I was talking to fixed income accounts and hedge funds about it all morning, and the equity market's just whistling past the graveyard, right? Because they're focused on the bounce in semis. But you kind of have these two little looming situations out there, and I'm not wildly bearish. It's not my baseline forecast. I get that the underlying fundamental story is strong, and we're going through a transition between AI-driven CapEx and broader CapEx, and I do think we can make it through this transition. But having an August risk off is looking like an increasingly probable event, because even if we don't get a rate hike next week, and I don't think we will, and we shouldn't, we're likely to get a hawkish press conference, right? And potentially some guidance, like the May 2004 guidance when they started talking about removing policy accommodation in a measured way, and no one really understood what Greenspan was trying to say. And then in July or in June, they raised the policy rate, and boom, 10-year treasuries went up 120 basis points or 110 basis points in 6 weeks, and real rates shocked higher and vol shocked higher, and we had a risk-off sell-off in the equity market, and that could happen again, because if you take that probability of September up to 75, even if what he really intends to do is what I'm talking about, that's a tightening of policy too. It's a little more complex and people don't understand it quite as well. But if you end those bill purchases and then you change the duration, the reinvestment strategy to shorten the duration of their treasuries outstanding, which is much longer than the current stock of treasuries in the market, that would tighten policy on the back end, right? And that's what the back end's been pricing, with 10-year real rates at 235, 10 basis points through my target, up, 50 or so this year. The market's already pricing that tightening of financial conditions. So the equity market's been ignoring it. We've got the VIX down here and VIX EQ up here, and you could get a rate of change, a slowdown in CapEx at the same time that you get a bit of a repricing of VIX, because everyone says, oh boy, maybe there is macro risk. And the yen sells off and people get worried about the yen carry trade and Japan selling treasuries and that permeating out through Europe because they wouldn't just be selling treasuries, right? They'd be selling French oats and bunds and everything else. It could be
let me
one of those
let me
August when people
piggyback
get
on
called
this.
back from the hand.
Yeah, no, you definitely done a really good job of kind of painting a picture here of a volatile late summer. But let me ask you, the thing that has been a real head scratcher, kind of an exciting head scratcher for me being a metals and precious metals and mining guy, is this week we started finally seeing a nice move higher in gold off the roughly $4,000 an ounce. But it's been doing this in the last couple days with higher rates in the bond market and with a strengthening higher US dollar. Now, we've seen this before recently as gold, when gold had that big move higher a couple of years ago, we saw a similar move. Now, if I'm looking at these correlations, we're typically antithetical to one another, but now are working in tandem. I'm starting to think maybe there's foreign central bank buyers once again. Maybe China's coming in, buying the physical market. We'll see. But I'm just kind of saying, if is gold at all being any sort of bellwether for you, and your macro thesis here moving forward, or if not, maybe what is gold representing in this whole move? Because the way you put it, if it's a hawkish Fed next week, I mean, we could be in for another rug pull in the gold market.
Yeah, I don't view gold as being particularly related to U.S. financial conditions to real rates. I view gold, that rally in gold earlier in this year in particular was driven by a rebalancing of global trade. So if you're China and you're no longer accumulating dollars the way they once were because you've been able to reroute your excess manufacturing capacity to Europe, or you're transshipping through Mexico, you're accumulating everything else other than U.S. dollars. You could convert them to U.S. dollars, but chances are, you wind up with euros, you wind up with Mex peso or whatever. So what do you do with that? You don't sterilize it and put it back into into yuan, because that would drive up the value of the yuan and reduce your terms of trade, and then you wouldn't accumulate as much because they're so dependent upon that. So you put the money into gold. And there's a lot of countries in East Asia in particular that are accumulating a lot of dollars right now. Now, one of the offsets to that obviously is the price of oil and the fact that these countries are structurally short oil, which is Japan's big problem, and why I should have mentioned as I'm discussing the probability of a big drop in yen. Last night's trade deficit, was supposed to be, 120 billion yen or something, and it was 400 and change, and that was because crude imports were up 58% or something. So Japan doesn't benefit from a weak yen the way they once did because they're short crude, and the dollar, as I've mentioned to you in the past, is a petrocurrency now. It's positively correlated with the price of crude because we went from being the world's biggest importer to the world's biggest exporter. So, this creates sort of a problem for all them. Now the market, other markets, not the crude market itself. The crude market's a spot market. Jeff Curry does a good job explaining this. I have a good friend who runs trading at one of the big banks, and we talk about it being a spot market, needs to clear kind of thing. But, you look at the break-even inflation curve, they're figuring, this will not go on long enough to create crude going to 120 or whatever. There'd be a reaction function from the president were that to be the case. So it's not really expected to persist, but it's a spot market, and Japan is short it, and Korea's short it, and Taiwan is short it, and China's short it. Now, China, part of the reason they're not having a problem, we know they built inventories, but also their economy is probably not growing at all. So domestic demand is really weak, but nonetheless, they're still pumping out exports, accumulating foreign currency. They've kept their currency relatively stable. It's drifted up a little bit, but they're probably buying gold. So
Yeah.
Bitcoin's a different story. For me, Bitcoin is all about dollar debasement, growth of U.S. spending, and that's more of a midterm. We're going to run into the debt ceiling next year story. So Bitcoin could come back to life next year, but that's a totally different one. And it's on a
Bitcoin
different
has
path.
seemed like just kind of a call option on, tech. I mean, it's really
I don't view it that way. I
weenier.
view it as a call option on the U.S. debt, and the U.S.
Okay.
debt stack starts going up again. Now, the last 2 months, you've seen interest expense as a percent of GDP start to ramp again a little bit
Yeah.
in the U.S., and that's just the financing. Like government spending growth hasn't picked up, but if you look at the makeup of government spending growth, discretionary spending's down 4.6% or something year to date on year. Mandatory spending still up 7%, and even Medicaid, which was supposed to slow this year because of eligibility requirements in the One Big Beautiful Bill Act, ain't slowing. It's at 10% growth.
Mm.
And that's because they're using more benefits because presumably the blue states are finding ways to pump the money, everybody's money out the door. So next year you run into the debt ceiling. If the D's take the House, like in 2018, the deal's going to be more spending, and then the U.S. debt stack starts going up, and then
Well, I'm
that would,
I'm
to
glad
me,
you
that would
mentioned
be
that.
a catalyst for Bitcoin moving again.
I'm glad you mentioned that because the one statistic that you and I always kind of bring up when in discussing is how the Biden administration ran government spending to the GDP was at 24%, and
24 on its way to 25. Yeah, it's at
yeah,
23
and
now, but to get it to
so it
20,
has come down. It has come
yeah,
down a little bit.
yeah. Well, that's because it's running at 3. It's been running at 3% for the first 21 months of the Trump administration, which is below nominal growth, right? So if you run spending below nominal growth over time, that's how you get it back to 20% of GDP. It's unclear that'll
Mm-hmm.
happen. We'll have to
Does
see.
does the Department of War going in and asking for a lot more money due to Iran have any implications on that? I mean, does this
It does, yeah.
prolong?
But defense spending as a percent of GDP is at its all-time like post World War II low. So it's an issue, but the real issue is mandatory spending, right? And it's
Yeah.
Medicare, Medicaid, Social Security. It's really Medicaid and Obamacare subsidies that blew everything out, right? That's
Mhm.
how we went from 20% to 24, 23. And so one way or another, you have to slow the growth of Medicaid and Medicare spending to below the growth rate of nominal GDP. And 10% Medicaid spending right now is crazy.
Yeah.
Just
Yeah.
shows you the program's out of control. But anyway, and so it's not, yes, the deficit could widen a little bit because there's been 70 billion of tariff refunds and there's another 100 billion to go. But I never really worry about the receipt side because, as we've discussed, the median since World War II has been 17.1, subject to only an 80 basis point standard deviation by each administration since World War II. So
Mhm.
simple way to think about it, Democrats come in, raise taxes, it goes up for a year, then goes back to 17.1. Republicans come in, cut taxes, goes down 80 basis points and then goes back to 17.1. So like receipts are what they are. And I never thought tariffs could
Mhm.
fix it. There's no easy way. That's just what we can collect.
Yeah.
So if we spend more than 20, the debt will go up. And that's just how it's worked since World War II and how it's likely to work going forward. And we're at an unsustainable level right now at 23. So
Yeah.
so that's sort
I
of the
want
gold story, but again, the oil story and how it impacts the rest of the world is really the interesting piece, and it's a vulnerability because, as I said, we're the yen to come under a lot of pressure. They are the biggest global holder of fixed income offshore, and it's very clear that what they've done for 25 years has made their economy. I don't know what the undynamic, you know, It's basically destroyed bank profitability, credit creation, and it's been bad policy. So even last night when the Nikkei got not crushed, sold off, you look and you see the banks up 2%. So they were talking about rate hikes last night. Banks go up. Ultimately, rate hikes are a positive for the Japanese economy, not a negative.
Do you think investors underestimate the significance of what a different regime in Japan looks like, a different economic regime looks like?
I do, in terms of being able to invest in the rest of Japan besides Tokyo Electron and Advantest, which is, I mean, the Nikkei, the KOSPI. People talk about the KOSPI all the time. It's like, hey, you wake up, you got to see what the KOSPI did to know what is going to go on with the U.S. today, because it's a levered call on the tech trade or AI theme. But the same is true of Japan, right? So I think when they can normalize monetary policy, get to positive real policy rates, that will increase their bank profitability decidedly. And I should put some numbers on this. Like, return on assets in Japanese banks 2 years ago was 20 basis points. It's 100 in the US. ROE was 4 and change. Below 10% ROE in the US, banks trade at a discount to book value, and credit creation is effectively zero. You get that ROE up, and all of a sudden the banks start lending money, creating credit, the whole economy booms. And by the way, that was what happened in the 60s was in the US was bank regulatory relief financed that CapEx boom in the 60s. Same thing in the 90s, regulatory relief after the savings and loan crisis under Greenspan, helped finance the boom. And that we need the same thing now. We're likely to get it. But Japan needs to normalize monetary policy, regulatory policy, and so they can participate in a broader way, right? The economy won't be just two stocks.
So I'm glad you mentioned the KOSPI, because this is something that's been of discussion with me for obviously the last number of weeks, and behold, call it what it is. I think it's very interesting. And actually, Grant Williams published an excellent newsletter, as he always does, but this month was actually about the KOSPI, and I read it yesterday. And I don't know if it's fair to put any sort of similarities between the Nikkei and the KOSPI, because Japan's really focused. It hinges on policy, where the KOSPI is the mechanics of it all are completely leveraged to two different plays. But Grant called the KOSPI a high beta play on global capex. And so if we are seeing the KOSPI really starting to unwind, and we had that conversation about capex and AI and really the acceleration of that slowing down, and maybe that's a representation of that as well, the move in the KOSPI. But is this ultimately some sort of canary in the coal mine with U.S. markets? Now, I know not everything's hinged on two equities, but it is, I would maybe argue to say, equivalent to a lot of the stock market hinged on one specific sector and seeing that speculation way off. I mean, is the KOSPI that canary right now for you watching all this?
It's a reasonable characterization. After Micron reported in mid-June, the title of my note that week was Demand Destruction. And the idea was, if you raise the price of something fivefold, you get a 3-year contract to sell your DRAMs. It's commodities, right? I mean, it's an incredibly cyclical business. And right now you're in this one-time huge build out of infrastructure, and you're going to need more and more compute. And Jevons paradox is a real thing. You'll drive more demand over time, and maybe they are moving to a permanently higher level. But you raise the price of a commoditized product fivefold, I mean, you're going to destroy some demand. I think what people are sort of forgetting about the whole AI boom in the US is this is not a command and control economy. If the people that are spending all the money, i.e. those big four spenders, see their stock prices fall again for another quarter after they report CapEx, that spending is going to slow, right? And orders for semis are going to flatten out. And then they're already trading at low valuations because expectations are that this trees don't grow to the sky, right? So, I mean, our SK Hynix and Samsung and all the, the most Hynix in particular, one of the most pure plays on this, Hynix, Micron. Yeah, I mean, that's the picks and shovels. You need the DRAMs, you need semis to make this whole thing go, but it's also going to be the first thing to crack. And like I said, the SOX index down 20 is just a round number. A 38.2% Fibonacci retracement, and I just know enough about technical analysis because you have to. 40 plus years in the business, you pay attention, right? But it's the golden mean, and you come down 38.2 and the bull market's still intact, provided you hold there. You go through that, and all of a sudden you're scratching your head going, well, maybe this is peak, right? So I don't think the cycle's over. I don't think it's the end of it. But there's so many structural problems with the Korean markets and the Korean economy, the whole chaebol thing, not managing for shareholder value. Japan started the whole shareholder revolution, and it sort of took hold in Korea. But the way those markets work, their underlying fundamentals, like I used to talk about population with clients when I was Barclays equity strategist, and I would say, like, hey, Chinese population is about to peak, and the Koreans are going extinct, kind of thing. So, these have been dynamic economies that have been out in front of tech, but not really in front of tech, like fast followers. It's not a great economy to invest in because it's wildly cyclical. And these are cyclical businesses. They just are. Now we're in a, one-time demand shift level boom. And the art here is to try and see when the stocks will peak before, the credit cracks and unwinds, and but that's the art of the whole thing.
Barry, before we let you go, let me ask you a big question here. I mean, you're well in tune with some of the main, big money, institutional money is doing. What is institutional capital doing these days? Are they as concerned as you are, but are they forced to maybe continue to chase returns? What is that dynamic between institutional and the retail capital right now?
Yeah, well, let me frame it with some hard numbers. So in my weekly notes, at the end of those notes is a sector allocation and then an asset allocation. The sector allocation is very specific. So is the asset allocation, but sector allocation is very specific. I'm 25% tech right now. I'm 5% communication services. Communication services is 2 stocks. Like 80% of that sector is 2 stocks. The underlying index is 38% roughly tech and 10% comm services. So this is a big underweight. And then I'm overweight industrials, I'm overweight financials, very low weights in consumer discretionary staples. Anyway, the tracking error, the standard deviation of the return of my model portfolio or recommended portfolio to the S&P 500 is about 6.5%. That is a very large tracking error. There's active managers that will take that amount of risk for sure. But that's a lot of risk. Certainly no quantitative manager or someone who, is heavily scrutinized by consultants trying to attract institutional pension fund money. That's a lot of risk, 6.5%. And that's that amount of an underweight tech is a very tough trade for a big, long-only institutional money manager that manages institutional money, not retail money necessarily. But even then, within retail, does retail want someone who's got that big and underweight in tech? I don't know. I think it's the right place to be. I think even being market weight, those sectors, for a investor managing his own money or a hedge fund, like hedge funds could get longer, but then they can easily get out of the trade, right? For most investors, being market weight tech and comm services to me borders on reckless right now. That's half of your portfolio in a single theme. I'm not managing my money that way. It's just too much risk. I've been riding the wave. I'm out. I'm about 200 basis points above the S&P this year because of some of these other bets. And, within financials, I've got the KRE, which is up 20%. So regional banks over the big banks. So things are going pretty well, but that's a big structural tech short. And so I think that's a hard trade for an institutional money manager. Now, the truth is that being long market weight tech is a hard trade for them too, because they have concentration rules related to, things like the 40 Act and all. So like some of these names have gotten so big for them to even be market weighted is tough. So they're in a really difficult spot. How do you participate in the rally but not get crushed by it, right? How do you shade your bet, and what do you think about it? It's not easy. That concentration creates massive problems for institutional money managers on both sides. Like taking a big bet against it or even being in it, because then you have, concentration risk problems. I hope that's a decent answer.
No, we will see how August plays out. I mean, I think he put a little bit of a stern warning here for our listeners here. Not so much, obviously we're not, this is one of those conversations, as they typically are here, Barry, about we spend a lot more time talking about the big picture of things, less time on the metals and miners, but that is going to be really important.
I should mention too, Trevor, that I've got about 15% cash or 14% cash in that equity portfolio. And so again, because I don't think it's the end of the cycle, if we get, big old drawdown here, you're in a position to take advantage of it. And I don't think ultimately, I think Warsh knows, and I listened to every minute of that press conference. I think he shares my views about this unbalanced policy, and we'll get to the right place when these task forces provide the structural support, and he's able to convince the committee that they're in the wrong place with the balance sheet. And they need to slowly unwind that, not on autopilot, but unwind, reduce that and that accommodation and ease the front end and rebalance policies, stabilize the housing market, broaden out the growth, Main Street over Wall Street, as Treasury Secretary Bessent. So I think we're going to get to the right place. But for now, I think we're at a really tricky transition point in the AI trade and in the policy background, and a decent risk-off shock seems reasonably probable.
Okay. Barry, good to see you once again. It's been far too long. How's the golf game this summer?
Well, we'll see this weekend. Remember guests. So, last year we made it.
Barry did not ask me to be his guest, and for quite
no, that's
good reason.
Right. Last year we won our flight. It was a different guest, but we won our flight and we came in third in the shootout. So, we'll see how it goes. I'm not taking penalty kicks anymore. I'm not playing Sunday morning soccer. So this is my competition fix.
Yes.
So after 52 years of playing soccer, I am all in on competition, betting some money, and Anyway.
Very good. Love it. All right, my friend. Good to see you. Thanks so much. Ironsides Macro. I will put a link to his Substack into the show notes. Highly recommend an inquiry into the newsletter. It goes in depth, more than on the macro side, makings of the market, better than almost anybody out there, I would argue. Barry, thanks so much. Talk to you again soon.
All right, thanks.
The information presented should not be considered investment advice. Mining Stock Daily and its affiliates are not responsible for any loss arising from any investment decision in connection with the material presented herein. Please do your own research or speak with a licensed financial representative before making any investment decisions.